Back in 2011, I lost $30,000 due to a single trading mistake that most traders don't even realize they're making. And here's the crazy part. It wasn't because the strategy stopped working. It wasn't because I was breaking my trading rules. It was because I misunderstood one of the most important concepts in trading: risk exposure. You see, many traders believe that the more assets they trade, the more opportunities they have, and technically they're right. But there is a hidden danger that can turn what looks like a trading gold mine into a ticking time bomb. But before we get into that, let me answer a common question for you. A trader recently asked me a question about profitable trading strategies having losing years. Because when most traders hear the word profitable, they imagine something that consistently makes money month over month, year over year. But that's not always how trading works. Like most things in trading, there isn't a simple yes or no answer. There's a lot of factors that go into it. So today, we're going to break down whether profitable strategies can have losing years, why that happens, the importance of building a balanced trading portfolio, and how you can avoid making the same devastating $60,000 account mistake that I made. And no, you didn't hear wrong. It actually was double what I mentioned earlier. Now, as I mentioned, a trader recently reached out to me and he asked the following. He said, "Akil, do profitable trading strategies have down years?" I know the answer seems obvious, but please humor me. I asked because I just built a strategy that has an edge and I tested it across 2.5 years on the euro dollar and gold. But 2024 was a slightly negative year on gold. Overall, the expectancy was 1.04 across the data set. So I was wondering. And essentially what our trader is saying is this: I built a strategy. I tested it across 2 assets. Overall, the strategy is slightly profitable, but one of those assets had a losing year. Does this mean that something is wrong? And that brings up our first lesson. One of the biggest advantages that professional traders understand is the power of building a portfolio. Now, when I say building a portfolio, I'm talking about trading multiple assets, I'm talking about trading multiple strategies, or ideally a combination of both. The goal is simple. You don't want your entire trading business to depend on one thing working perfectly because, well, if you do, that's just not a very safe environment to put yourself into. And one of the easiest ways I can explain this is through real estate. See, when I first started investing in real estate, I owned a single property. It was a duplex in the city, so essentially one big house that was split into 2 units. Me and my roommates lived in one unit, and there was another family that lived in the other. And honestly, what I love most about this property is that it provided profit and it provided safety at the same time. When everything was going well and the rent was coming in on time, I could cover the mortgage, I can cover expenses, bills, and still have a little bit of money left over, which eventually found its way to my trading account where I would proceed to lose it by doing dumb things in the market. Hey, cut me some slack here. I was a different trader back then and I come from the same places that you come from. So it is what it is. But the important part was what happened when things weren't going well. If the other family had trouble paying rent, which unfortunately was a common occurrence, I wasn't completely wiped out. I still had income coming from my own unit that allowed me to keep my head above water. And that's the power of diversification. The idea is to create multiple streams so that if one is struggling, the others can pull the weight. Eventually, we expanded our real estate portfolio, and while, yes, having more properties created more headaches, it also created a much higher season for our profits, and it provided a lot more protection when an individual property underperformed. And trading works the same way. A trading portfolio gives you flexibility. One asset may struggle while the other performs well. One strategy may go through a drawdown while the other one is killing it. And that balance is extremely valuable. But there is a downside, because more doesn't always mean better. Speaking of better, you know what works better than just giving you a course and sending you on your way? Yeah, actually working with you through the process. And that's exactly what we do every single day over at Tier 1 Trading. Whether it's through our live rooms, our coaching sessions, or our supportive community of both new and veteran traders who hang around to help out. So whether you're just getting started or looking to take your trading to the next level, check us out, www.tier1trading.com. I recommend starting with the risk-free 14-day trial. That way you can test everything out with zero commitment. All right, back to the video. When most traders first discover the idea of building a portfolio, they immediately think, if one pair gives me opportunities and opportunities make profit, then imagine how much money I can bring in if I trade 20 pairs, for example. And that mindset is very dangerous because your ambition grows faster than your skill level. When I first started trading, my goal was simple. I wanted to make as much money as I possibly could. So when I learned about trading portfolios, I thought I found the cheat code. More pairs, more opportunities, more money, baby. Except there was a problem. My skill level as a newer trader did not match my ambition. And because of that, I constantly found myself overwhelmed. I was watching too many charts. I was analyzing too many markets. I was trying to manage too many opportunities at once. And what happened? Well, I missed trades because I was distracted. I made simple mistakes because I was just too overwhelmed. And I became less efficient because I was rushing to get to everything. And instead of improving my trading, I was actually bleeding my account quicker than ever. You see, a portfolio only works when you have the ability to properly manage it. Another major problem that comes with a large portfolio is overexposure, and this can come in a few different ways. The first is simply taking on too much risk. The second is taking on too much correlated risk. Now, many traders understand the first one. If you risk 2% per trade and you've got 5 positions open at the same time, then you have a maximum of 10% open risk or open exposure. The correlation one, however, is where things can get a little bit tricky. Now, I promise I won't get on my big rant about correlation. You guys know what that does to me. But correlation simply means how different assets move in relation to each other. For example, the Australian dollar and the Kiwi dollar often move the same because Australia and New Zealand's economy are very closely connected. Another example is the Canadian dollar and oil. Because oil plays such a major role in Canada's economy, oil strength can often lead to Canadian dollar strength. However, the biggest mistake that I made when it came to correlations came from a little bit of a different scenario. A scenario that cost me $60,000. So after learning to trade and going through my ups and downs, right, I used my skill in the market to start managing accounts for others. It wasn't necessarily my first choice option, but once I realized that the reality of trading wasn't turning a $10,000 account into a $1 million account by the end of the year, yes, that's a real dream that I had. I needed something to pay the bills, and this was a way to turn my trading into a business and do so. Now, just to touch on that, I would say this. If I existed now, I would certainly take the prop firm route, as I think that matches kind of my goals and intentions and personal desires a lot better, but that just wasn't really a big option back there aside from like the brick and mortar, and I didn't want to up and move someplace. So I was trading a portfolio of about 12 currency pairs, which honestly was probably already more than what I should have been trading at the time. But the biggest mistake wasn't necessarily the number of pairs. It was the fact that half of those pairs contained a single currency, the Japanese yen. And don't get me wrong, this was great through all of the testing. As you can imagine, I had a profitable strategy. The yen pairs, although they tend to follow each other, when my strategy made profit, that meant they all made profit, which was good for making money. So I didn't have any red flags during the backtesting process. In fact, I didn't have any red flags during my initial trading process until March 2011 happened. So I remember I was actually on vacation, and of course, like any trader who struggles with boundaries, I snuck away to check my charts. And that's when I saw it. A massive 9.1 magnitude underwater earthquake hit Japan, and that triggered a devastating tsunami. I don't remember all of the facts, but I think like 20,000 people lost their lives and like 50,000 were displaced. It was a big deal. And as you can imagine, the yen moved very aggressively in reaction to this. And unfortunately, all of my positions were on the wrong side of that violent move. And when I say all of them, I mean I had about 6 different trades involving the yen at the same time, and they were all moving against me. Yay for me! And $30,000 later, I learned one of the most important lessons of my trading career, and that is having multiple positions doesn't mean you're diversified if all of those positions are exposed to the same risk. But wait, the story gets worse if you can imagine. After fighting with every bone in my body not to like take my setup and smash it over my leg and throw it out a window, I decided a better alternative was to shut things down, and I stopped trading for a week. And it was mainly due to me just not really being in the mental state to trade, right? We always talk about doing a self-checkup every morning before you trade. If you have a death in the family, a bad breakup, or you're sick, if you're just not mentally ready to attack the markets, it's probably not a good idea. I was very depressed, I was very rageful, and revenge was on my mind, and that's all that would have happened if I popped into the charts. That, or I would have been scared to death to take anything. Anyway, I took some time off, and when I eventually returned from vacation and started looking at the charts again, I realized that the markets had completely recovered, a nice little V reversal. And the thing that hurt even more was the fact that if I just would have kept trading and followed my rules, I would have made $60,000 back in profit. Yay for me. So a painful lesson, but also a very valuable one, as most painful lessons are. Now, one thing I really respect about this trader's question is the fact that he discovered this before putting any significant money at risk, so before live trading. And that's exactly why backtesting is so important. And if you're new to the concept, here's a quick breakdown of what backtesting is. Backtesting is simply the process of using historical data to test whether your strategy actually has an edge, so whether it makes money or not. And while backtesting has become a lot more accepted today with traders, there are still a lot of people who avoid it, right? They say things like, I don't want to backtest because markets changed, or how about this? Past performance doesn't matter because it doesn't predict the future. And yeah, technically both those things are true. But avoiding testing because the future is uncertain doesn't really make any sense. And the real excuse is that you're just being lazy. I mean, think about it like this. Imagine you are a business owner, right? You own a McDonald's franchise and you want to open a new location. My question for you is, would you do research on that area? Would you study the demographics? Would you do a traffic analysis? Would you perform competitor profiling? Or would you just start building without doing any research and go for it? Obviously, you would do research. Trading should be treated the same way. Duh. Now, with this specific trader, when it comes to their backtesting, there are some important pieces of information that are missing. Now, understand that this was just an online message, so this is not a trader that I'm working with. I'm not coaching them. I'm not mentoring them. So I don't know the details of the strategy. I don't know the time frame. I don't know the frequency. I don't really know any information aside from what they gave us in the question. But one thing I would say is that unless we are referring to a very low time frame for day trading, and even then, I probably want some more, 2.5 years of data just isn't enough. I mean, think about it like this, right? In 2.5 years, gold could easily have one positive year and one negative year, especially with all the war stuff that's happened this year. Sorry, buddy. So basically, that's a coin flip, right? Let me ask you this. What happens if we were to test another 5 years and gold only had that single losing year out of 7? Well, we might view it completely differently. What if we tested another 5 years and gold continued losing and only had that 1 year of profitability? Well, again, we would probably view it a little bit differently. You see, the more data we have, the clearer and more reliable the picture becomes. And this is why we typically recommend that our traders aim for at least 100 trades per time frame per asset, or 5 to 10 years of data, because small sample sizes can create misleading results. Now, when I personally test strategies, I like to cast a wide net. I like to test as many assets as possible, with the exception of a few that I know I have zero interest in trading for various reasons. Then what I do after that is I put these results into 3 main categories. Category 1 is going to be the losers, or to be politically nicer, right? The pairs that do not perform well. Nah, they're losers, whatever. Anyway, these are the assets that simply don't work. They lose money, they don't provide any value, they get removed and thrown to the side right away. Category 2 is what I like to call the steady Freddies. These are the assets that aren't necessarily impressive. They don't produce the biggest winners. They don't give you amazing results, but they are consistent. Think of them as like the player on your sports team who doesn't really score much, but they do all the important work. They may not show up on the stat sheet and they may not be visible to the public eye, but they're very valuable when it comes to keeping the bigger machine working. Category 3 is going to be your superstars. These are the assets that produce amazing results. These are your big performers, but they often come with a lot more volatility as well. Think of this as being like your superstar athlete who scores a lot every game, but also struggles defensively. Yeah, they can win you some matches, but they can also create problems. So there's a kind of a balance. And these are the assets that may often have incredible years when they're good, but when they're bad, they may throw that negative year in there as well. Now, the goal of all this breaking down and dividing into categories is to find the right combination. Yes, you want enough superstars to generate those nice returns, but you also need enough steady Freddy performers to keep the ride smooth. Now, if you're asking me personally if I would rather have every single asset in my trading portfolio be profitable every single year, my answer would be absolutely. If everything was equal, I would certainly choose consistency over maximum profitability every single time. But that's also because I'm naturally more risk averse when it comes to trading. So what I value most in the markets, especially at this point in my career, isn't necessarily explosive growth. It's consistency, it's predictability, and it's longevity. Because to be honest with you, I'm not trying to get rich quickly. I'm trying to build something that can last for decades. And that's the question that every trader needs to answer. Are you looking for the highest possible returns, or are you looking for the smoothest possible journey? Because those two things aren't always the same. A profitable strategy or asset, right, because it could be both, can certainly have losing years. The question is whether the overall performance of the trading portfolio can carry the load when it does, and if the upside of dealing with that negative year is worth it. And that's something only you can decide. Hey, if you want to hear about another interesting and controversial risk management technique, check out this video on the 3-5-7 rule. And if you enjoyed this video, make sure you subscribe to the channel. Each weekend, I put out my big trading edge video where I break down all of the trading opportunities that are on my radar for the week ahead. And then throughout the week, I sprinkle videos like this covering trading psychology and maybe some other technical lessons. My goal is to help you become a better trader. Your goal is to become a better trader. So make sure you take advantage of what this channel has to offer. All right, until next time, plan your trade, trade your plan. Take care.